We had talked about the accounting equation being assets equal liabilities plus owner's equity. And this is the foundation of accounting, in that our assets always have to equal our liabilities and owner's equity. It always has to maintain that balance. And so today we're going to go through a few transactions and see how they are impacted by this accounting equation and how it fits into the accounting equation. And the important thing to remember is that every business transaction affects at least two accounts. It's called double entry accounting. And so for any transaction that we're going to have, at least two accounts are going to be affected. And as we go through this, you'll see how all these components fit together. Now in our example, we're going to talk about Jim's Lawn Care. And Jim Smith, he's the owner, and we call it Jim Smith Capital as the name of the owner's equity account. We're going to have one liability account called Notes Payable, and so I have that listed under our liability section. And then we also are going to have three asset accounts. In his business, he's going to have cash, he's going to have some supplies, and lawn equipment. The total of all these assets always has to equal our liabilities plus the owner's equity. So let's look at our transactions now. The first one is that Jim decided to open this lawn care business. And he invested $5,000 of his personal money into the business. So in transaction A, we have Jim Smith decided to start a lawn care business and invest $5,000. Well, you have to ask yourself, what did the business receive in that transaction? Well, they got $5,000 cash. So under the cash account, I'm going to list $5,000. And under Jim Smith Capital, I'm going to list $5,000. Now, in our transaction, the cash is offset by the owner's equity. And remember, when we talked about owner's equity, we said that was the owner's stake in the business. So Jim invested $5,000 in the business. If tomorrow he got a job offer and he decided that he's not going to do the lawn care business now, well, he's entitled to get that $5,000 back. He invested it, he can take it out of the business. And that's what that represents. So that's where our first transaction would look like. The second transaction I have here is that Jim purchased $100 worth of supplies for cash. Well, in our supply account, Jim Lawn Care now has $100 worth of supplies, more than it had before, but it had to give up something. It had to give up $100 worth of its cash. So I am going to show that by putting the $100 in brackets as a negative. And now I can come up with a balance amount of this account. Well, now I only have $4,900 worth of cash, but I have $100 worth of supplies. I don't have any lawn equipment. I don't have any debt, any payables, and my owner's equity balance didn't change, so that's still $5,000. Now, if you add up the assets together, they still equal $5,000. The liabilities and owner's equity added together equals $5,000, so we're in balance. 5,000 equals 5,000. Again, for every transaction, we've affected at least two accounts. Now in this third transaction, I have that Jim purchased a $2,500 lawnmower by paying $1,000 down payment, and he signed a notes payable for the remaining $1,500. He decided not to pay the cash for that today. He signed a note, and he's going to pay them at the ending of that note, whether it be 30 days, 90 days. And so let's record that transaction. Well, in this transaction, Jim has a lawnmower now that has a $2,500 value. So under lawn equipment, I'm going to write $2,500. He paid cash of $1,000, so my cash account is going to be decreased by $1,000. And he also has a note payable now. He has a debt of $1,500. So in this transaction, we actually affected 3 accounts. But the impact of this, $2,500 minus $1,000, means the net increase in assets was $1,500. The net increase on our liabilities and owner's equity was $1,500. So that equation balances out. Every transaction has to balance, and after we adjust these accounts for that transaction, our assets have to equal our liabilities and owner's equity. And if we consistently apply this, they always will. So let's do our totals. Our cash balance now is $3,900. We still have $100 worth of supplies in our storeroom that we haven't used. We have lawn equipment worth $2,500. We now have a notes payable of $1,500. And our equity wasn't changed in this. It's still $5,000. If we add up the total of our cash plus our supplies, that's $4,000, plus $2,500 of equipment, we now have assets that total $6,500. If we add up our liabilities and equity, those total $6,500. So we're in balance. Our assets equal our liabilities and owner's equity.